We've all seen this new wave of smart money traders plastering YouTube with their claims that they've cracked the code and now found the greatest thing since sliced bread. But if that's the case, why is it their strategies are still not working? Does this mean that the algorithm is changing? Are institutions now targeting smart money traders? Should we really stick to SMC, or do we need to start learning smart money traps? Let's break this down so we can avoid the common mistakes that unfortunately all of the struggling traders tend to make. Now, if you are new here, my name is Kieran Davis and I've been a full-time trader for the last 5 years. I've helped tons of people transform their trading just by watching this YouTube channel. So grab a notepad and pen and let's get right into it. Before we get into the chart work and I reveal exactly how you can avoid these common smart money traps, we must build the right foundation, because without this, nothing's going to stand the test of time. So let me ask you a question. How many times have you had that initial thrill of learning a new strategy, constantly hit and take profit, but then for some weird reason, nothing seems to work? So you go back to the drawing board, you start tweaking your plan. All of a sudden, you trade it again and the profits are rolling in. However, for some weird reason, it just seems to stop working. The losses start to pile up and the cycle's repeating. You know, we might be thinking that banks might be clocking onto our strategy and they're starting to hunt our stop losses. Is it really that the algorithm is changing? And do we really need to learn something new? The simple answer is no. But Kieran, they don't work for me like they used to work before. Of course they don't work. It's because you're constantly changing the context in which you're applying them. You see, you have to navigate these different market environments in different ways. Just like if, for example, we went to the Arctic, we're not going to wear flip-flops and shorts unless you're strung out on crack. Now, I want you to understand something. When it comes to these markets, there's 3 different environments that are driving price. And if you're not aware of this, you're going to constantly stay in that cycle of losing. How can you expect to take profitable buys if the market is melting? You see, technical analysis can be confusing and ambiguous. The first thing we need to do to stay safe from these smart money traps is understanding the 3 different market environments. What are these 3 different market environments? The first one is what we call a risk-on environment. The second is a risk-off environment. And the third is a hedging environment. What do these ultimately mean? Well, the first type of environment we have is risk-on. And this is when you see money start to flow out of the world reserve currency like the US dollar. And naturally, when that happens, you'll see the US dollar start to lose value. So if you're now trading US dollar pairs and you're seeing a bullish entry signal, majority of the time, these trades are not going to play out because there's no fundamental reason for investors to actually want to accumulate price and drive it higher. If the currency pair is not going to appreciate in value, why would they buy it? It doesn't make any sense. So of course your buys are never going to play out. Now, the second type of environment is what we call risk off. And this is when the conditions are not favorable for investment because we're seeing things like interest rates start to rise. You see, naturally, when interest rates rise, investors are going to pull their money out of risk assets such as crypto, such as the stock market, and put it into safe havens or things like the US dollar, because they are anticipating that because interest rates are rising, those government bonds and that currency will generate a better yield than the risk assets. What we have to understand is that in that environment, money will flow out of risk assets, they'll begin to drop and flow into the dollar. Now, the third environment is what we call a hedged environment. And this is when essentially economic conditions are a bit uncertain. You know, we might be seeing conflicting data. We might be seeing some parts of the Federal Reserve, being risk on, some of them might be risk off, and it will just be indecisive. So in these environments, it's very crucial to understand and know that we're in a hedging environment. And these are the times when you're going to play both sides of the market. You'll see sell side being offered, you'll see buy side being offered. And it's not your job to try and predict, oh, it's going up, it's going down. You'll just go to the chart, identify both of the buy zones and sell zones and play both sides of it. You see, it's crucial to know this. Otherwise, you're always going to be on the wrong side of the market. When we go to the charts, we can't just be an amateur and just say, oh, technicals are the only thing that drives the markets. Remember, smart money means larger players. It's the larger institutions that have billions and trillions of dollars that can actually influence price. And you got to ask yourself, are they actually going to be investing based off squiggly lines? Look, no, they're going to look at macroeconomic data. And one thing they pay attention to is called monetary policy. So what do we mean by monetary policy? So this is understanding things like inflation data and interest rates to determine, are they raising rates to go on a risk-off environment or lowering the interest rates to go on a risk-on environment? Let's take a look at a few examples on the chart and show you guys exactly how this influences price. And then we can mix in our technical analysis. So if we look here, this is the data for US dollar CPI year over year, which you can just Google and find it on pretty much any website. Now, take a look at the key dates here. We can see inflation data year over year back in 2021 from February to March finally start to rally in price. Now, when inflation rallies, investors understand that naturally the Fed do not want high levels of inflation because high levels of inflation means things are more expensive, cost of living rises, and of course, that's just not good. So when inflation starts to rise, naturally the Fed don't want that. They have a target of 2% inflation. So when it starts to deviate from that and rise, they'll begin to raise interest rates with the goal to lower down inflation. And again, raising interest rates makes the currency more attractive for foreign investment. Because when you have a higher interest rate, you get a greater yield, a greater return on investment. It's like if you had the option, for example, for a 5% interest rate, you're going to put your money there because you're getting a guaranteed interest of 5%. So let's take a look at the data. We can see here, for example, in February and March and April, inflation data started to rally up until June 2022. Now, let's look at these dates on the chart. If we look at, again, March, April, and May in 2021, this was the local bottom of the US dollar. How convenient is it that as inflation starts to rise, we now see the US dollar follow that uptrend? And then what happened? Coming to the end of 2022, let's look at the data. Let's see if we can figure out why the US dollar started to drop. Coming to the end of 2022, look, August, September, October, we saw inflation start to come on a downtrend and start to fall. Now, again, this doesn't mean that instantly the markets have to drop or instantly the markets have to rise, because sometimes there are a few other influences which I have covered in my fundamental analysis video. If you haven't seen that, go down to the description and you'll be able to see all of this in more detail. From June, July, August, and September, that was when inflation really started to fall. June, July, August, September, the US dollar prints its top and then starts to fall off and depreciate in value. So just by understanding inflation data, just by understanding risk on, risk off, and understanding what's going on with this data, because remember, when inflation rises, naturally the Fed want to raise their interest rates. When they start to raise their interest rates, that makes the currency more attractive for investment because they get a greater yield, they get more bang for their buck, get more money on their money. So that will drive money into the US dollar and it will start driving money out of risk assets. So for example, if we start to look at some risk assets like crypto, for example, how convenient is it that the top of the last bull cycle was printed at the end of 2021, the start of 2022, when we went on that bear market as inflation started to rise? Because when inflation was rising, everyone was anticipating that the Fed are going to start to raise interest rates. When they started to raise interest rates, investors started to take their money out of risk assets and park it into the US dollar as safe havens because they understand it gives a greater return on investment. And the charts are reflecting that. So once we can understand this fundamental analysis, once we can understand the economics, this is what gives us our bias without even needing to look at a chart. The problem is you're coming to the markets trying to apply smart money concepts and bullish order blocks in a bearish environment, or you're trying to trade bearish order blocks in a bullish environment. So you have to understand the macroeconomics and what is going on fundamentally before we can even apply it to the charts. So that was the first way to avoid these smart money traps, by understanding the macroeconomic and the fundamental narrative. Because again, if we understand where investors are flowing their money and why they're flowing their money, now we can get an actual reason into why we should be looking for bearish order blocks, or why we should be looking for bullish order blocks, or looking for buys or looking for sells. You need that fundamental narrative first so that you can stay on the right side of the market and not just get chopped about. The second way to avoid smart money traps is understanding, are we seek and destroying, or are we rebalancing ourselves on price? Now, the market will only ever do two things, which is seek and destroy or come back to rebalance itself. And when you can understand these Wyckoff price cycles, this will give you a much greater narrative to know, should I be buying or should I be selling, in confluence with the fundamental narrative. For example, so when it comes to understanding seek and destroy and rebalancing itself, you must understand the concept of premium and discount pricing. This is very simple. So to identify this, you firstly have to identify your first Wyckoff schematic in terms of your price cycle. If you're like, Kieran, what's a Wyckoff schematic? Let me show you. What Wyckoff shows you is how supply and demand is actually introduced to the market. And when you understand this, you're going to completely avoid these smart money traps, because what we're studying here is how institutions are actually fulfilling their orders, where they're seeking and destroying, taking liquidity, or obviously rebalancing price. So what you can see here, Obviously, when the market is in that risk off environment or in that risk on environment, depending on the asset you're trading, you may be in a bullish market or you may be in a bearish market. So if we're in that bullish market, for example, and we know that dollars should be appreciating, we will see a bullish market cycle where you're seeing these accumulations, you're seeing these reaccumulations, until eventually you come into a premium price. And what is premium? Well, I'm going to show you in a moment. But eventually, once you do come into premium and the narrative starts to switch, the market is going to want to rebalance itself back to a discount. Why would it come back to discount? Well, let me ask you this. If you had the option to buy something at £10 or £5, what are you choosing? Of course, £5 all day. We want the discount. It's the same thing with these larger players. They want to buy from discount and they want to sell from premium. So you'll see these distributions form when you've created new highs on the market. You'll see these accumulations form when you've created new lows on the market. So if we take a look, we can see what does the market do over here. It creates our accumulation of price. After our accumulation, what happens? We come up and we create a new high, invalidating the distribution. So at this point, because we're now at new highs, we're now trading above new highs, we're in premium market. And when you're in premium, we understand the sellers live up here, and you'll start to see the market distribute. Now, we're going to talk a little bit more in detail about these manipulations so that you can avoid the exact smart money traps in a second. Just, we need to understand this first, because if you don't have the right foundation, mate, nothing's going to work. Now, we distribute to come back down to discount and mitigate prior levels of demand. From there, we've now rebalanced ourselves. The market now wants to seek and destroy and take the rest in liquidity above these highs. After it creates those new highs, we're now sitting in premium because we're trading above a prior high. The market is going to want to rebalance itself and come back down to a discount. Now, you might be thinking in this example, Kieran, well, why did the market not come back down to the 50 or the 80%? Now, if you're like, Kieran, what's the 50 or the 80%? Again, we've done videos that go in so much detail about these 50 and 80 levels to show the exact key zones that I buy and sell from. Again, the link will be in the description if you want to watch them. Now, sometimes if the market doesn't want to come back down to discount, it's only because of one reason. They did not need to come to discount. Why would they not come to discount? Because they don't need to fill their orders. The only reason they come to discount or take liquidity is not to hit John's stop loss. Like, come on, do you really think these institutions who are trading billions and trillions of dollars are going for John's micro lot size? Of course not. So if they can get their orders filled at a higher price, they will. And normally what will happen is once these scenarios happen, for example here, where you see these reaccumulations, this is because they picked up majority of their orders in discount after the accumulation. And once they've created these accumulations and creating these reaccumulations, you just trade the same narrative. Once we've created a new high relative to our old distribution on the left, we're now in premium price again because this is our leg that we're trading in. Anything above this high is premium. Obviously, if we measure this sell to buy movement, the 50% of that will be discount. So when we're trading in premium price, we're anticipating those distributions and those sellers to come in to rebalance the market back down to discount. And then once it comes down to discount, we're looking for an accumulation again to send it to new highs because now we're in the seek and destroy phase. And when you're in those seek and destroy phases, this is when you want to be buying. When you're in a rebalancing phase at premium price, that's when you want to be selling. So the real edge here is now combining that fundamental narrative with this technical narrative. Are we rebalancing or are we seek and destroying? For example, if we're seeing the US dollar in a risk off environment and we know the interest rates will be higher for longer, that tells us that the DXY will be bullish. And now we'll be looking to sell things like Euro USD, GBP USD, or other dollar crosses that are driven by the dollar, of course. So once we've got those two, we now need the third step to actually avoid smart money traps at entries. Because how many times have you gone to take a trade, you've got the direction right, and it hits your stop loss before the real move occurs? Mate, that used to happen to me all the time before I understood these Wyckoff schematics. So at this point in time, we had a bullish fundamental narrative for gold because we was entering that risk-off environment. We were seeing inflation data come lower, which was obviously causing the dollar to sell off and causing dollar crosses and risk assets like, for example, gold to appreciate in value. When it comes to understand those concepts we spoke about, right, you use the narrative fundamentals. Are we risk on? When we're risk on, you'll see metals, you'll see gold, you'll see silver, you'll see cryptos, you'll see the stock market rally in price. Then you want to use that Wyckoff price cycle Understand, are we seeking, destroying, or rebalancing themselves? And then essentially identify one of these Wyckoff schematics, which act as a level of demand. Wait for the market to come back. All right, so if we identify a Wyckoff schematic, we can see our reaccumulation of price over here. Remember, these are not chart patterns. It's a study of market behavior. Reaccumulations is when you see the market manipulate the lows, followed by break into the upside. And that's what we can see here. The market is in an uptrend. We know we're in an uptrend because we're in that risk on environment at the time. And then we want to find our bullish price cycle. This is our last reaccumulation where price comes up, manipulates our lows, then breaks to the new upside. And we understand that anything above these highs is premium price. So I don't want to be buying up here, right? I want to wait for the market to rebalance itself and come back down to discount at my 50 or 80 zones. Now, typically, this is where a lot of traders can fall into these smart money traps, where they're not validating their entry criteria. Now, the reason why you need a validation criteria is because technicals are very subjective. And normally what people do is they'll identify a schematic or they'll identify an order block or a demand zone, which they're all just the same thing. Remember that, right? This is like all these different strategies you see, whether it's smart money, ICT, it's all just different perspectives of the same car crash. So when we can see our key zone here, what will most people do? They'll just blindly jump in, right? Maybe put an entry here, stop below the low, and then target the next liquidity point or target the next zone. Now, for me, I don't want to do this because this isn't validating my entry. When I see these prior levels in these key zones, it tells me, yes, buyers once lived there, but I need to validate them once price actually comes back to these zones by looking for my lower time frame confirmations. And what is that lower time frame confirmation? It's understanding that when the market comes to these key zones of supply, of demand, the market must, and this is by law, this is not my opinion, this is the facts of the market that Richard Wyckoff discovered almost 100 years ago. You can Google his name, I've done a lot of videos on them. Now, what they will do is remember, before the market moves, these larger players who control the market, they need to generate liquidity. They have to get their orders filled. They can't just come down and trade like us on MetaTrader and just, drop 20 lots at one level and instantly get filled. These guys are trading billions and trillions of dollars. So it takes time for them to accumulate price and split up all those orders. When the market comes to these zones, to stay safe from these smart money traps, wait for these lower time frame confirmations, which essentially is allowing the Wyckoff accumulations to actually form. Now, there's a few reasons why we must wait for these. Number one, institutions can't just come in and trade like us and drop 20 lots, 40 lots at a level and the market instantly fills us. They're trading hundreds of lots, thousands of lots, because they're trading billions of dollars. So when they're trading this much money, it takes time for their orders to be filled. It's like, for example, if you want to buy a crypto coin, right? If there's only 10 coins for sale at a certain price point, you can't buy 20 coins at that level. You have to go to the next price point where it's available, the next price point, the next price point, the next price point, until you've got all your orders filled, then the market will move. It's the same thing here. They'll create these accumulations. So instead of you just blindly jumping in the market, allow these schematics to form so that you're not getting manipulated out of the market and then sitting there like, oh no, I missed the market. Allow these schematics to form. Allow the manipulations. Now, when we say these manipulations, you can see what they have to do is allow time to pass and opinions to form by consolidating price. Let the consolidation manipulate lows, then break to the upside, and then trade the retest or mitigation of that. So for example here, we can see in our Wyckoff accumulation, all right, we get our SC, our AR. Now, if you're like, Kieran, what are these zones? What are these labels? I have done a completely in-depth Wyckoff bootcamp on my channel. I will post a link in the description to that as well. Now you can see we get our phase A that stops the prior trend. We now go into phase B where time is passing, opinions are forming, and this is where they're filling the bulk of their orders. Now phase C, this is where you get your final spring, your manipulation, your smart money trap, which all these online gurus are trying to claim. This is just Wyckoff strategy. This has been around for hundreds of years. Now, after you've got that spring, the key is, are you going to get a sign of strength? Are you going to get an actual follow through to validate their orders actually being filled? Because if their orders were filled, you'll see price actually push off those key levels. Just like, for example, if this microphone was really hot, if I touch it, I'm going to move away really quickly. All right, if it's hot, I'm not going to be slowly keeping my finger there, am I? I'm going to move away really fast. It's the same thing here with price, right? After you get that manipulation, that's the hottest point. That's where the final order's being filled. So if their order's being filled, you'll see a sign of strength. And then how do you get in for an entry? Well, all you do is you measure. Again, this is your order block, right? If we look at this now on a 15-minute time frame, Now, if you look at this on a higher time frame, it's just going to be your order block. It's going to be your institutional candle. Remember, all of these strategies are the same thing. It's just different perspectives. And when you get a more accurate and better perspective, that's what leads you and allows you to get more accurate trading results. So again, how do we trade it? Right, we just measure that sell to buy. We can set a limit order on the 50, set a limit order on the 80. Again, I've done in-depth videos on the exact entry criteria, but depending on the risk to reward, I might offset it and put one limit on the 50, stop below the 80, and have a backup entry on the 80% with the stop below the low. And then from there, let it play out. We can see price come in, it comes into mitigate, and now it goes for our target. But what's our target? This way you zoom out and remember, seek and destroy and rebalancing. We just rebalanced price to the left. We've came back down to demand. So now we're going to want to seek and destroy and take those new highs. And then long and behold, what does the market do? Bang, comes up, hits our target, and then we're laughing to the bank. So now that you've got this, it's time to actually start collecting data based on your trading journal, because every single person is going to have different characteristics and different habits. For me, I found the Asia session wasn't worth my time and effort because of the return on investment compared to trading London and New York. But again, that comes down to the individual based on your habits, availability, and your personality. And once you've got the technicals out of the way, in my opinion, this is one of the most least important things, because you have to think about trading correctly. And to think about trading correctly, you need to think in terms of sample sizes, because we take losses so personally sometimes. And we think that, oh, I've lost this trade, or I might have done something wrong, or there might be something wrong with me. So what do? We go out, we figure out why we lost, and we start changing our trading plan. And then what happens? We lose another trade, we do the same thing, and now we're in this dangerous cycle of constantly tweaking and changing our approach. Remember, if you've got an inconsistent approach to the market, you will have an inconsistent result. You can't keep tweaking your plan every single day. What you put in is what you get out. For you to trade correctly and think about this in the correct way, you must think in terms of sample sizes. So when my trading plan plays out, look, I'm not going to win every single trade. I know I'm going to have losses. I know I'm going to have winners. But on a trade by trade basis, I have no clue whether I'm going to win or lose. And anyone who tells you that the next trade is going to win or lose, they're just lying to you. No one knows. You see, you have to understand that there's a random distribution between wins and losses for any single trading plan. So if I know I can't predict the outcome and I don't know if the next trade is going to win or lose, well, how do we make money? Your trading plan must be backed by data. It must be proven to be profitable. I didn't come into this and just make my own trading plan. I found someone who's already profitable and I literally just copied their trading plan word for word. Now, you've got that, it's backed by data. You have to think in terms of sample sizes. So when you see your entry criteria play out, don't think that the next trade must win. You're thinking in terms of sample sizes. It's simply your objective to follow your plan and manage risk for 10, 20, 30, 40, or 50 trades. It's like if we flipped a coin, right? I know that, okay, if I flip a coin 5 times, I'm not going to say that that coin is just dominated by heads. I know that there's luck involved, and sometimes it will be heads, sometimes it will be tails. But I couldn't bet my life if the next coin flip's going to be heads or tails. So if it did land on heads 5 times, what am I going to do? Well, we're just going to say flip it 10 times, flip it 20 times, flip it 50 times. And the more we flip it, the closer we're going to come to that 50-50. Obviously, your trading plan shouldn't be 50-50. You should be trading very high probable setups. Just because you've lost or just because you've won a trade doesn't mean you should go and change your trading plan. Sometimes you have to think in terms of sample sizes of 20 trades, 30 trades, 40 trades, and 50 trades. So if I take a loss, okay, that's just 1 out of 20 trades. What I'm going to go and do is take that same trade 20 times, 30 times, 40 times, 50 times. And then once I've got to the end of that, I'm going to review it and figure out, well, what's the biggest commonality between my losers? For me, like, I became profitable trading literally any session, but over time and collecting data, I found that Asia wasn't as profitable compared to London, New York session. So by following my data, that's what allowed me to increase my win rate and increase my overall profitability. So for you, once you've got your trading plan that's proven to be profitable from someone else, and you've implemented it and you've hit that baseline of profitability, now you can go in and study your habits. Now you can go and start to tweak things based on data, not opinions. And remember, when we say data, I mean large sample sizes, 10 trades, 20 trades, 50 trades, 100 trades. The larger the sample size, the more accurate your data will be. So I want you to remember this, that there's no such thing as a smart money trap. All there is your personal perspective on the markets. And these markets are going to continue to move how they've always moved. Look, Go and check it for yourself. Go and check the same trends, the same movements, the same Wyckoff schematics. They've worked for hundreds of years and they will continue to work the same way. All of these strategies are just different perspectives of the same thing. And look, I know that profitable trading, it's not easy, all right? But it's very, very simple. And if you actually want to guarantee yourself success in these markets, you have to do the following things. Number one, follow a completed strategy from one person that has the exact results and lifestyle that you want. Do not deviate from this. If you try to add your own spin on it before you hit profitability, you're never going to get profitable. It's like, oh, if I wanted to be a heart surgeon, I'm not going to go on YouTube, or I'm not going to go to one medical school, a second medical school, and follow a bunch of different curriculums. I'm going to follow one plan from one school, and I'm going to stick to that one thing. You'd literally follow it through to completion. You're not going to change it. You're not going to deviate. Because if you do deviate, if you do change it, well, how are you going to get the right results? Would you trust a surgeon who learned off YouTube and learned from a million different schools? Or would you trust a surgeon who went to the best medical school, done one curriculum, followed one doctor, and got the best results possible from sticking to one thing? I know what I would choose. Once you've got this mentor, show him your working, show him your technical analysis, and make sure that you're actually applying the strategy correctly. Because practice, it doesn't make perfect. Practice makes permanent. So if you're not applying it correctly, you're just going to reinforce bad habits and poor application. And then 6 months later, you're going to be like, oh no, I'm still losing, and be crying all day because you're practicing the wrong thing. Number 3, think in terms of sample sizes. Remember, if we flipped a coin 5 times and it landed on heads, we're not going to say it's dominated by heads. We're going to flip it more until our data starts to show itself. Elevate your perspective, get out of the moment and think about the next 20 trades, 30 trades, 40 trades, and only look at your results and start to change things at the end of the sample size. So you can see your exact stats, you can see exactly what you're doing right, exactly what you're doing wrong, and then figure out what you can change. Number 4, stop changing your entry criteria after one loss. Give yourself time to see the results of your trading plan over that large enough sample size. Remember, luck can play a factor. Anyone can win a single trade. But being consistent over weeks, months, years, and decades, that's where the true skill set lies. And number 5, remember that successful traders, we focus. We follow one course until successful. Every strategy will work. It's just, are you applying it in the correct way? And your trading account is what's going to show you the results of that. If your trading account is red, if your trading account is blue, it's always going to be a reflection of you. So thank you guys for watching. If you did enjoy this video, don't forget to comment, like, and subscribe. And hey, let me know in the comments one thing you liked, one thing you learned, and I'm gonna see you guys at the top, from the top, because the bottom is way too crowded. Sheesh.